The EU has once more cut its outlook for growth in the Eurozone to just under 1%, while unemployment remains stuck at 11.5%. And in the meantime, the proliferation of jargon is on the rise.
The rate on the deposit facility was lowered by 10 basis points. The Governing Council decided to start purchasing non-financial private sector assets, with underlying assets consisting of claims against the euro area non-financial private sector.
So let's have a look at Mario Draghi's recipe for economic recovery. Well, first, take aside the members of the Eurozone that have been bailed out and separate them from those that haven't. Next, promise to shore up those countries that are struggling with a hefty dose of something called OMTs. These are outright monetary transactions, and Mario Draghi promised them back in 2012. Left to cool in the fridge for a couple of years, mix in some hefty German resistance and concerns about the effects of bond buying on future inflation. If the policy refuses to set, add in some LTROs, or long-term refinancing operations, to the mix. TLTROs should be added, or targeted long-term refinancing operations. Forget the so-called MROs, or main refinancing operations, to address any specific holes in the liquidity provision. And then add in a few interest rate decisions, bringing the cost of borrowing across the Eurozone to record low levels. Recently, the ECB tried to win over investors with promises to buy ABS, or asset-backed securities. But some were left dissatisfied, complaining that the portion size wasn't enough. So, to boost the economy, the ECB has very few options left in its rather bare cupboards. One of them is the LSAP, or Large-Scale Asset Purchase Programme. This is what the rest of the world already calls quantitative easing, or QE. But it may come too little too late to please the fussiest of traders. To complicate matters further, just as that dish may be ready to serve in Europe, it's just been taken off the menu in the United States by the Fed. Nina dos Santos, CNN, London.